Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Richard Marwood of the AXA Distribution Fund for his 3 stock picks. Hi Richard.
Hi Emma.
So what's the first stock you're going to highlight today?
The first one I was going to talk about was Inmarsat.
And why do you like that?
Well, from a very conceptual point of view, we like businesses that have got great barriers to entry, things that you couldn't easily replicate yourself. And I think it's fairly safe to say that building a satellite communications network is not a thing that's very easily replicated, and that's what Inmarsat does. That's used in a variety of different areas. It's used for communication in shipping. One of the new areas that they're coming into now is, and I'm not sure I'm a fan of this from a personal point of view, but they're going to put Wi-Fi onto aircraft, which could be a huge growth area. So very, very strong barriers to entry, great technology. You can see why they're going to grow in the future, pays an attractive dividend. Very happy to carry on holding Inmarsat.
And presumably a rather, as you've alluded to, their diversified revenue stream. They're across a number of different other business sectors, aren't they?
Yes, I mean, shipping traditionally was a big one for them, but they have a reasonable amount that goes into the military from aircraft and from satellite phones, those kind of things. So it is quite diverse. And
what's the second stock today?
The second one I would highlight would be Whitbread.
And why do you like Whitbread?
Well, Whitbread, it's got some very, very strong businesses and brands. I mean, we're all very familiar with Premier Inn and Costa Coffee, and they've done a great job of rolling out those businesses. And I think that they'll carry on rolling those businesses out, both domestically and internationally as well. I think as we look at the UK equity market and the economy next year, we might find that people have just got a little bit more money in their pockets as real wage growth starts to tick up. So actually, you know, they might buy an extra cappuccino or they might have an extra night away in Premier Inn. So I think that could be quite positive. The only thing I'm watching there quite carefully is one of the reasons that we're going to have a bit more money in our pockets is because there's going to be a bit more real wage growth. And clearly, Whitbread is quite dependent on the people who work in the coffee shops and in the hotels and the restaurants to service those customers. And they're going to have a little bit of a balancing act just between managing their own wage costs against the positive turnover effects of their customers having a bit more money.
And of course, next year we may well see interest rates rise. In fact, we probably will see interest rates rise. Yeah. There is some concern that will sort of negate the disposable income factor from the wage growth because, of course, people will see things like their borrowing costs go up, mortgage costs go up. Is that something that you're considering?
We're considering it. I'm not sure I'm overly concerned, really, because I think the one thing I would say, I'm not completely convinced that the base rate has set the price of money for a little while. So actually, although people have got an indirect linkage, I don't think it'll be one for one in terms of interest rate increases on base rate and what people will actually pay. I don't think it'll be that material.
And what's the third and final stock?
Well, the third one I would highlight would be Glaxo.
Of course, pharmaceutical that everyone knows. Why do you like Glaxo?
Well, I like it partly because people don't like it very much at the moment. It's quite a controversial stock and people have been reasonably negative on it. A lot of that negativity has been around their ability to maintain the dividend. And they have given commitments that they will actually do that in the short term, but people are still questioning that longer term. The one thing I think, though, is that they have got 4 strong businesses there. It's maybe the structure that they're held in and the lack of balance sheet flexibility that holds them back. But I think there's some attractive businesses there that in the longer term will generate value.
Because Glaxo, of course, was tarred by the bond proxy brush, which a lot of people have been saying over the last year, which is these equities that behave like bonds, they just they don't have much growth in share price, but they kick off an income. When interest rates start to rise, they're actually going to be hurt. But you say actually you're not convinced by the fact that the dividend is shaky.
The dividend is a little bit questionable. I think that's true, but the thing that will be incumbent on the company then is to actually show some growth, which I think they will be able to do in the future, and that will shake off the bond proxy tag, providing you can get that growth.
Richard, thank you very much.
Thanks, Emma.
This is Emma Wall from Morningstar. Thank you for watching.